All right. We are ready to roll and get started. We're going to do something a little bit different today. We, for the last few weeks, have been talking about specific programs or products. 5-day HELOC we talked about last week. We've recently talked about down payment assistance programs, and one in particular that Jordan is very partial to. We're very partial to right now for several reasons. We talked about DSCR, and we'll talk about more programs in the near future, like the all-in-one simple interest product, and probably some hard money. Talk a little bit about that. But today, we want to pull back the curtain or let
Yeah.
let you see under the hood, whatever analogy you want to use. And Jordan is going to talk about and demonstrate, talk through, etc., pricing or shopping rates and some of the logic behind how lenders structure their offerings and their rates and why that's relevant and what you should know about that so that you can have more educated conversations with potential clients and borrowers, and just be better educated yourself about how some of this works, which some of you, your eyes may glaze over for some of this, but I think it's important in this industry that you understand, because when you get a question from a borrower and a client, you can always say, well, I can find that out for you. But if you can have an educated response, you've now deepened the relationship with them and demonstrated to them that you're a market expert, a knowledge broker, etc. So I would hope that we're going to get some great questions on this
We'll
topic.
keep this one pretty interactive. I
Yeah,
usually like them pretty accurate on this one.
absolutely. So you can use the
Areas.
Q&A box or the chat. I'll try and monitor both of those. And we'll just keep it interactive. We'll talk about some of the strategies here, and quite honestly, we also want to demonstrate the value that there is in working with a mortgage broker like we are, and the fact that we can go and find the best deal when it comes to rates or options, programs, etc. And give you all maybe a little more confidence in referring your clients to us, and letting us do what we can to best help them. So, Jordan, where should we start on this topic of shopping for mortgage rates?
I want to hit on, like, when I'm talking to my sales staff, right? Right now, especially right now, there are objection after objection on rate. And that's really what I want to, kind of center this around and talk a little bit of how to really chat about it, and how we decide what interest rates clients get, because there is a decision. Interest rates all relative to how much money you want to pay, such as a buy down, right? You will hear that term a lot, or how much money you want to get back, which is a lender credit, or a credit of some sort. And we use the term par rate as a lot as the rate that doesn't cost any money, you know.
Say that
Um,
again. Say that again, Jordan.
Par rate is the rate that doesn't cost any money. So just like in par, zero, in golf,
Right.
par for the course. So you're not going to add any points or take away any
You're
points.
not you're not plus or minus.
Yeah.
If the par for the golf course is 72 and you shoot a 72, you shot par.
But
And if anyone on here has done that, kudos to you, because I've never
yes,
come close. Anyway,
but it's important to be able, especially in this market, right, to talk to clients for them to understand. And I'll give you an example real quick. When we're talking to clients and we're chatting about whether or not they should do a buy down, what does it make sense? Does it not make sense? Rates just pretty much, dramatically dropped, in the last 30 days, right? 1% or so. And it's relevant to understand where the market is going, right?
yeah.
And what our rule of thumb is. Typically, our rule of thumbs are depending on uh, uh, essentially, how long until we get to that next refi point, or how long does it cost? Do we want to buy down a rate? And how long does it take us to get us to that next point where we think the next rate drops will be, or, next 12 months, do you think we will refinance? That kind of thing. My rule of thumb right now is, 12 months really is, if we can, on a buy down, or if someone's paying for a rate, if we can make our money back in 12 months on the monthly payment, and we'll go over that, what that looks like. It's a good deal, but explaining that to clients in a way that makes sense to them is super important, because a lot of them will see that 7.5% and they're going to immediately freak out and say, I'm done. I don't want to buy right now. It doesn't make sense. But I'm going to tell you guys, I looked at locking someone at a 5.875 today. It's doable. It just depends on their scenario, if it makes sense, and is it the best financial decision for them.
Yeah.
And being able to walk through that with them and show them what that looks like is super, super important. So when we're going over this with clients, typically I'm gonna show you exactly what I do with clients when I'm sitting with them one-on-one, and walking them through it, and show you kind of the back of house of how we do that and how it makes sense. So can I get someone just to give me a scenario, like a traditional, FHA, VA, just a quick scenario, purchase price, zip code, and a certain number of money down, right? And
if not, I'll give you one. But
okay,
I would like there to be participation here, right? So
yeah,
let's get some
like an
scenarios.
FHA loan, if you guys want to look,
Okay, so
995,620. Okay,
and well, Kristen, I'm sorry, Kristen followed directions a little bit more closely. So, oh well, now Michelle's chiming back in. You pick, Jordan.
we'll do FHA and then we'll do Kristen's. Okay, so
Yeah.
let me get my chat back up here to look at this. Okay, so we use I personally use this. This is called Loan Sifter. Okay, it is just my way of looking up rates. I don't work with one bank. I know Josh has mentioned a lot of times. We've mentioned on these past calls a lot of times. Is I'm not working with one bank. I'm working with a lot of banks. Okay, and so we need a centralized system to look at rates very quickly. This is that system. Okay, and it's usually easier on traditional mortgages, such as FHA, VA, conventional. And when you get into DSCRs, you got to go direct to lenders, because they're more of like, think of them like mom and pop shops that are not quite signed
Yeah.
up with these. So,
Which we're
we
happy
get,
to do for your
yeah,
clients. It just
yes,
doesn't, it doesn't function in the same way.
yes. So with that being said, let's go ahead and look at a 445,000 FHA, in a 95620. 445,000. I'm going to go ahead and put 3.5% down, or a loan amount of 96.5, and let's say a FICO of 680, right? Let's just throw it in there.
Okay.
And we'll just do a primary residence, and everything else is fine. We don't really need to change anything else. Okay. So as you'll see, these are all the different banks. Okay. All right. And each bank is going to have their pricing. They're going to give their what we call a rate stack. Okay. That rate stack will dictate how much that client's going to either pay or get back. You'll see a lot of these are already in red. It's already pushing for buy downs. Okay. Doesn't mean when we open it up, right, they're all in red. You'll see how it turns green. Okay. The closest to par on a 680 FHA and a 445,000. So this would be a par rate. Okay. It's the closest to zero, right? Where it's $17, is going to be 6.625. Okay. Everything below that is going to cost buy downs. It's going to cost a certain amount of money. So can this person get a 5.25 interest rate? Absolutely. Sure. But it's going to cost them $13,000. Would that make sense? Josh, do you think that would make sense in this market?
The answer I would say is it depends.
It does. It depends on, can we calculate it? Right? Can we calculate it out to where it does make sense? So how long from the par rate would it take for us to make our money back? And we just simply take principal and interest here. So here's our principal and interest at, let me grab a handy dandy calculadora. Give me 1 second. 2,413. Okay. Versus the 2,798. Okay. So I take my calculator, I subtract the two, and the difference in a monthly payment is $385 a month. So my question is, when do you think that rates will drop enough to where we'd want to refinance again? Do we think that rates are going to continue to drop in this market?
All indications point to yes.
Okay.
We don't know. We're not Nostradamus,
Yes.
but if you listen to people smarter than us, all indications point to them lowering over the next 12 to 24 months.
Yeah, 12 to 24 months. So let's cut that into, let's say we make our money back in I don't know, 18 months. Okay? Or 18 months. So I take 385 times 18 because that's what we're saving per month. We're saving 380, we're paying $13,000 to save $385 a month. After 18 months, we make back $6,930. Would this be a good buy down?
No.
Why? Someone tell me why. Anybody? Someone in the
Sorry.
comments tell me why.
I'm not
You're
helping
right.
you.
You're right. You're
Audience
right.
participation. Why
Yeah.
wouldn't that make sense?
Why wouldn't it make sense?
And you can open your line too, or you can
Yeah,
raise
you
your
can just chat. Yeah.
Yeah. I may have to open it. It'll take too
It'll
long
take
to
long
pay
to
it
pay it
back.
back. We wouldn't make the money back. We wouldn't make the money back on it, and it doesn't make sense, right? We're not going to make that money back. But showing a client that, being able to say, hey, you're not going to make your money back, in the next 18 months, I would advise you to take the higher rate. Now it's a logical decision to them. It's not based out of, I don't know what's going to happen. I'm just going to wait it out. I'm logically thinking I'm going to get into this house now. We use the term marry the house, date the rate a lot. That's exactly what this is we would marry the house at 6.625 and we're going to date the rate until we can refinance. It would cost them less money to refinance in 12 months. And let's say, in 12 months, the rates are already at 5.25 or 5%. They can do a $13,000 buy down then, and most likely we're going to get into the fours. I guarantee we're going to be, maybe high threes, but definitely fours buy downs are going to be in the next 12 months, right? Which is going to be a much more, pretty number over the last 10 years. The 4% is going to be much more accepted over even 5, right? I mean, we were in fours forever situation. So that's going to be more than norm.
So Mike pointed out something great, this is another way to calculate this. Mike said the payout is 36 months. So the other way to look at it is you take the numbers that Jordan was just using and determine where is your break even point.
Yeah, divided by
so
385.
The break even point is the break even point is 3 years, and we think rates are going up, and we're sure or you're confident that they're going to stay in the home for 4, 5, 6, 8, 10 years. Then maybe it does make sense. Maybe. Yeah. So then the facts and take the emotion out of it. Exactly, right? It's not about you telling them what they should do. It's just presenting the information and the data and leading them to the decision or empowering them to make a decision that makes the most sense for themselves.
I want to talk about Kristen's comment just in a second, but I'm gonna chat about this just a little bit. Okay. I want to chat about something else. There are lenders do offer sweet spots for clients that they want to direct them into a certain rate. They make it advantageous to them in certain situations. I'm going to give you an example. Here's one example right now, okay, of a FHA buyer, where if you're looking at the rate stack, it's 19,000 for 5%, 16,000, 13,000, 12,000. It goes to 9, 7, drops to 4, goes back up to 5. Where's our sweet spot, right? They are trying to push people to this rate, 5.75. There's some algorithm with it, which I'm not smart enough to, explain it to you and why they do what they do. Banks are very smart to make their money, and they want to, continue to hold on to it. And it's probably the least likely it's going to be refinanced in the next 12 months. And they have some sort of formula that says, hey, if they pay X amount of dollars for this rate, we'll not lose money. Essentially, we'll be able to make some money.
I'll give a I want to give a different analogy unrelated to
Okay.
mortgage where you'll see this type of concept. If a lot of SaaS companies, when you go and look, they have multiple pricing options. They structure those in a way to try and drive you into a particular one by how they communicate the benefits, the features, etc. I mean, there is a science to all of that, and part of the value of what we do is helping your clients, regardless of what the motivation of the wholesale lender is, getting them into the deal that makes the most sense.
Yes. Now, with that being said, you hit on it. There are times where clients are so payment sensitive that uh that it doesn't um it doesn't make it doesn't necessarily make sense, but it's what they want.
Right.
I'll have clients that want to buy down their interest rate and they know they're probably going to lose money, but they would rather guarantee guarantee that interest rate.
Risk reward.
Yeah, versus the reward, right? They don't want to play the market essentially. In
Yep.
those situations, yes, we talk about it with the client, but I'm not going to pressure them into doing something that they're not comfortable with. The two most important things to us, and I say this regularly to clients, is going to be what is your cash to close? What is your payment when you go into an offer? If they're comfortable with those two things going in, they're going to be comfortable coming out. Okay. And that's really what we're shooting for, is to make sure that they're comfortable where where they are. But being able to have this conversation to say, hey, rates all relative to how much money you want to pay or get back. You could probably possibly get into the 5s right now. You could do it with seller concessions. You could do it with which is not necessarily, I don't offer that to clients a lot of times, especially in this market. It makes your guys' job harder. So if you're working with Originator that's just throwing that out all the time, we don't want to be doing that. We want to make sure that we make your guys' job easy, because we know that offers that don't get accepted never turn into a loan. But with that being said, that is something, if you're trying to overcome someone from rate reluctance, or hey, I want to wait until the market gets better. Do you want to wait? Because they're already they're in the 5s. Do you, and can you explain it to them, right? And be like, hey, rates all relative to how much money you want to pay or get back. We can look at the seller paying some of those concessions. Go ahead, Josh. Were you going to say
Well,
something?
not only that, so on the real estate side too, is showing them the data of where appreciation, even though appreciation has slowed, for the most part, in most markets, it's still positive appreciation. So how much there's a cost to waiting in several different aspects, right? If they wait to buy, if they could buy today or buy in June, they're probably paying more in June, and you can't renegotiate the purchase price you pay for a house after you settle. You can renegotiate the rate that you've got on a property after you've settled. So just being, not pushy or salesy, but it's another example of emphasizing what I think Michelle said. If you can show them in black and white, look, Mr. and Mrs. Buyer, is the average monthly appreciation for the last 18 months. What do you think it's going to cost you price wise if we wait another 6 to 12 months to buy? And they can start doing the math in their head, or they say, well, I don't know, and you do the math. Well, if they hold even on the low end, it's going to mean that $600,000 house is now 630, or whatever the numbers are. Anyway.
Okay. Uh, Mike says, just because we're on this, I'm gonna before we talk about Kristen. Mike says 6.25 looks like to be a better sweet spot. Yeah, yeah, if you don't want to come with any money out of pocket, it's absolutely going to be the, best sweet spot on this stack.
Yep.
They're definitely pushing to 6.25 on this. So with that being said though, let's do the math, right? Every time we want to make sure that it's uh it's not a guesstimate, that there is some mathematical equation that we can explain it to a client. So 7.75 is at 4,487. So that's 2,550. And then at 6.25, it's 2,690. Okay. Since we have a credit here, this is actually going to give them $961 back to closing costs. So they'll have to bring, whether it's their appraisal, whether it's an underwriting fee, or whatever it is, it would give them $961 to cover those costs. It could even be your escrows. It could be anything. Okay. Real estate transaction fees, 961. And then we're going to add that back into, because we're going to do the difference between, we're going to add that 4,487 to that. So the difference is $5,448. Okay. And then we're going to take the 2,690 principal and interest and subtract the 2,550. It's $140 a month. So 5,448 divided by $148 a month, it's 36 months. Do you see a trend there? This is a totally different bank, though. There's a trend there. Does anyone notice it? No? Almost all of them are going to be 36 months to make their money back.
Uh-huh.
Okay.
Yeah.
That is the norm. That is the
Okay.
norm. So do buy downs make sense right now in general if interest rates are going to drop in the next 12 months?
Probably not.
No, there's not a single one usually.
Unless your client
Yeah. Yes.
in their risk reward analysis decides that they're not willing to risk the idea that rates don't come down, or however you want to frame that, right? And ultimately all you can do is educate them and let them make the decision that is the best decision for them, and not just financially but emotionally for them.
So when I'm taking through a rate sensitive client, I'm showing them that. I'm showing that the average is 36 months, the payout. I'm showing them how it makes sense. They start to feel more confident because it's explained to them in a way that they understand.
Yeah.
And that they're going to make their money back in 36 months. It's like, oh no, it's like, I would suggest you take a par rate. Okay. And I suggest you take a par rate and refinance and then do a buy down, once you refinance at 12 months, or try to get it to where, we're a little bit, lower.
Yeah.
Is it usually a 36-month payout, not a bank thought on rate charges?
I think what he's asking is it you said how if you look at this table here, it 36 is the break even on a lot of these. Is that, I think maybe what he's asking is that typical, or does that fluctuate? And maybe
It
if I'm wrong,
fluctuates
then
a little
you'll chime
bit.
in
I
too.
mean, there will be situations where it does fluctuate. And it's not going to make, like, if I did the math between these two, right, it's not going to be 36 months most likely. I mean, we can do the math, but it just depends. A lot of them will be at 36 months. My rule of thumb on a refinance on buying down rates has always, in the past, before we had this volatile market, before we were doing before we were, kind of in this situation, uh the I would say, hey, if you make your money back on buy downs in roughly 36 months, before I even looked at the rate stack, I would say, You know, our rule of thumb is about 3 years. Does it make sense? Are you going to live in this house? What is your plan? Is it a home you're going to live in and fix it up and flip it in a year? Is it a forever home? You know, I'd ask those questions and then I would guide them and say, yeah, then a buy down would be, you know, makes sense if you plan on living there more than 36 months. That wasn't my standard verbiage. So it's kind of always been the industry standard, but yes, banks do look at anticipating higher or lower rates, and they'll try and make a rate look more advantageous to a higher, you know, a larger buy down to get them in a lower rate so they can keep that product longer, because the longer you keep that product, the more money the banks make. Right. So there is a formula and algorithm with it.
Yeah.
We are just looking at it from a perspective of real more simple perspective. Our perspective is how much money would we save monthly and how much that it would cost to us to make back what we paid.
Yeah.
Or how much would we make, you know, how long would it take for us to make back what we paid with our lower payment?
Yep.
And that will usually explain to clients in a more simplified format to where they understand. Now,
Michelle says they can do a 2-1 buy down off these rates and still refinance when rates drop. Correct? Question mark with seller credit, of course.
yeah, you can. Now with that being said, I'm going to be a proponent of this. Not that we do offer it, but a 2-1 buy down is okay. But let's say you're getting $10,000 in a 2-1 buy down. Okay, it's dropping your rate 2%. Let's say the rate is 6.625. Okay. And it drops you 2 points. You're gonna be at what 4.625
Right.
roughly starting out.
Yeah.
And
Yep.
it's temporary, so that's only going to be the first year.
Yep.
So how much? So we calculate that a little bit differently if 2-1 buy downs are worth it. But yes, it's going to be, because it's going to be kind of a gradually increasing effect, right? So you have to take that into your calculation. But as long as you refinance 12 months, there's same cost of, hey, what if you want to do a permanent buy down instead? I would offer both to the clients. Hey, this is a permanent buy down. This is a guarantee. This will go up if rates don't drop. Some people will go for it. You already got the seller concessions there, so you might as well, you know, utilize them if you can. But yes, the answer is absolutely. There is not any loan that would force someone to not refinance unless there's a prepayment penalty,
Yep.
you know, of some sort.
Jordan, do we want to maybe run another scenario? Kristen's
Yeah, we'll run this
scenario
scenario.
she
I
had
wanted to
given.
talk about this anyway because I
Okay.
know Josh knows this. But conventional loans are really not a good product for clients. And this is going to be a perfect scenario for that. Because we're going to get murdered, murdered on rate with that 660 credit score.
Well, but that'll be great to see though
Yeah, you would. Yeah,
in
I
black and
really,
white.
yes. So just to give you an example, there's two things about a conventional loan that people need to, really three things. One is the pros. Let's talk about the pros of conventional loan, is that the appraisals are much more lenient, right? And that's really where listing agents and borrowers have this stigma against FHA loans because of how the appraisal has to be in a certain situation. Okay.
Yep.
Now, downside is mortgage insurance is based off of credit score. So lower credit scores are really going to get hit hard on when I say lower, 660 is not a low credit score, you know, by any means, but you're going to get hit harder on conventional mortgage insurance than FHAs, because FHA doesn't matter if you're a 500 credit score or a 800 credit score, it's 0.55 to 0.5. Depending if you put 10% down or 3.5% down. It's a set amount, right? It's not a variable amount where conventional would be. It also,
Jordan, some of this is related to changes with FHA that occurred how long ago at this point?
About 8 months to a year.
Yeah. So this may be, you may not be aware of this even. It's very possible that you know, no one in the mortgage space made you aware of the fact that like it is drastically different, and you know, is glaringly obvious from the borrower's perspective.
Yes.
You know,
Ongoing conventional or pushing conventional, and it's harder to qualify for.
yeah.
Right. It's harder to qualify for. Now, that change was from 8 months ago, our mortgage insurance used to be a standard 0.85 on FHA. It dropped to 0.55. So it dropped 1/3 or ish,
Yep.
roughly,
Yep.
in cost, which made the mortgage insurance cheaper, which made the overall cost of the loan cheaper.
Yep.
Now people will say, hey, mortgage insurance and FHA, will last for the life of the loan with 3.5% down. Yeah, that's true, but you'll quickly realize the interest rate plus mortgage insurance is still less than the rate on conventional with 20% down.
Yep.
So it's by far a better product, but that's the second thing is the mortgage insurance cheaper. The third thing, it's more lenient. You have more options. I mean, you go down to 500 credit scores. I mean, there's a lot more options in getting people qualified for FHA compared to conventional, and that cost. Now, it also matters on how much money they're putting down, right? Every 5% on conventional will change on the cost of that mortgage insurance. At 97, if they're doing 3% down first time home buyer for conventionals, it's going to have the highest cost. 5% down, 10% down are going to be less, 15% down less until 20, they don't have any mortgage insurance at all. Okay. But let's run this real quick. So I'm going to change my product to conventional, drop this to 660 and 659,600 purchase price, which that could be a reason too that we go conventional, is because the loan limits, right?
Yeah.
The loan limits could be a reason why we have to go conventional, depending on what area that you live in.
Yep. 34110.
Or 23110.
23111. Sorry.
Okay, we're
Oh no,
going
it's to
back.
change it back.
Okay,
34110.
in
Yeah.
Florida. All right. So we're gonna go 660 conventional. Okay. Let's do VIP. These with no, they don't have, they're not, we're gonna ignore the top because they don't have any lender fees or LO comps, so they're not. Are there buy downs? Pretty much all the way through? All the way up to, let's say, really a par rate is probably gonna be the closest here or here. But at 660, you're at like, let's just say 7.625, 8.119. We're not going to really focus on whether this makes sense to buy down it to 8.19. It probably does. This probably does or doesn't, but let's just say 8.19, 7.625. That mortgage insurance, so this is the principal and interest, and then you have mortgage insurance, it will auto calculate here at 46.47. Okay, so there's total payment on this with mortgage insurance. I don't know if this area will have the limits that we need to show the difference, but we're going to try. Let's try to switch this to FHA. Let's see if we'll pull something. Yeah, it does. It actually has the loan limits allowed. So in that area. Okay, and let's go.
Wow.
Okay. 39. The closest to par. I mean, it's still getting a credit back, but 6.125. Okay. 3,916. I didn't do anything but take the rate that was closest to par. Okay. What is the difference? Same client.
$700. I can't remember.
Yeah, 700. Yeah,
Yeah.
4,647. It's about 600, 680, $680 a month.
So obviously that's better for your client, your borrower, and yet you may have a listing agent that balks at it, right? So you need to be, if you can have a educational based reasoning, and you could say something like, now if you're competing, that you might be in a different situation, but if you're the only offer and they say, well, they were really hoping for a conventional option, and I said, and you say, well, yeah, I totally get that. Unfortunately, if we switch to conventional, we're going to have to knock about $50,000 to $100,000 off the price to keep the payment the same for my clients. So would they rather take less and have that conventional financing, or are we good to go with the FHA pre-approval? And that was
There,
just me spitballing on, on the spot here.
taking it from another side, because it is a seller market, right? We understand that. Taking from the other side of it is a lot of times I'll say, okay, Mr. or Mrs. Client, do you want to pay to repair the house, right? What does the house look like? It matters what the house looks
Right.
like. If it's
Yes.
missing a rail or not missing a rail, is do you want, a lot of times it's educating them to say, okay, uh what is that cost? Because it was what, 6.5, I think, somewhere around there. It was 6.5, which is $11,000. Surely the FHA repairs are less than 11 grand. It would cost them less than 11 grand, and it's definitely not going to be, is it worth the save $700 a month to put $2,000 or $3,000 out to fix that house, to put it into an FHA, um, uh,
Yep. Yep.
FHA ready? I would absolutely say yes, right? In that situation where if the client has that money, and I explained that to him, I was like, hey, we could take this, do this at this, or you could go into your offer at XYZ, or whatever it is.
And this is where your sales ability as the real estate agent comes into play as well. And being able to include in the offer, or just have the conversation with your borrowers. Here are the things that I see as potential red flags from an FHA appraisal. Are you willing, borrower, to resolve those issues so we can give the seller the confidence that, hey, we're not going to come back with FHA repair requests. We're going to handle the FHA repair requests up to X amount. We'll handle all FHA appraisal repair requests up to X amount of dollars. And that's where you being an expert as well comes into play, because you've been through the property and you're looking, you know that your borrowers are FHA. You're looking for those red flags, the chipped paint, the railing, it's a lot of times it's little stuff. There are big things that can pop up, but a lot of times it's things that are little things, outlet covers, um,
Just to show you a mathematical example on that, $5,000 would pay back in 7 months going FHA if you put 5,000, if they did that addendum to offer.
Yep.
And it will open you up to where your FHA clients will get more FHA offers accepted, because there's this it's just the fact that those have to be repaired, right?
Yep.
It's the fact that they don't want to deal with it.
And we've had a bunch of transactions where the borrowers resolved the things that came up on appraisals. I've had borrowers go and scrape and paint on the outside because the window frames
Yeah,
had chipped
frames.
paint. We've had people do fairly significant repairs. There's a risk to that as well, if something happens with the deal. But like, in the market we are currently operating in, with low inventory and it being a seller's market, sometimes you got to get a little creative and a little bit more risk reward in that scenario. But I mean, hopefully you see here in black and white, from a monthly payment and interest rate perspective, it's not even close right now.
Yeah. Do you want to talk about competing, how we compete, or do you, because I ran this all at full comp, no competition whatsoever.
Let's do that. Just one question I want to make sure
Yeah.
that I don't forget about in here was from Mike. How do you calculate the cost of a buy down? How are those calculated?
We don't calculate it. The lenders would calculate it based
Yeah.
off of credit, down payment. I mean, the whole, a lot goes into that scenario. But we put that information in here, and every lender already has that set where it's like, hey, if we're offering, and think about it in buckets of like 20, right? We talk about it a lot. If you guys don't know, anybody in the call, that I did a credit repair for a long time. I do credit repair with clients, not credit repair, but credit direction. I
Yep.
help them boost their credit. I have 2 clients right now that had no credit scores that were buying houses that have now 700 credit scores and within 30 days. It is something that we do offer and do for free. With that being said, that's what goes into the factoring is every 20 they fit into a bucket, and all rates are going to be giving. It's going to be say like, hey, at a 6.5%, it's going to be 660 to 680. And then once they hit the 680 bucket, they'll get a little bit of better pricing. But it's not as drastic as people think. It's not like we're going to drop a whole percent, right? So I'm going to give a example. This is the FHA here. Let's use a specific lender. Let's use Keystone. So they're at 6.125 at a 660, okay, on FHA. Let's bump that up to 700. That would be essentially two buckets, right? Two buckets. Look at that. They're still at 6.125. So it's essentially two buckets. It's not, it's a little bit better on credits. The buy downs are probably a little bit cheaper, but for the most part, it's going to be roughly the same. I mean, people don't get too terribly much more. Once you get into 640s, probably get a little better. And then sometimes people are more aggressive with lower credit scores than higher credit scores. And some people are more aggressive with higher credit scores than lower credit scores. Depends on what kind of portfolio they're trying to build. So every lender is going to be different, but that's where working with a broker is where if you're working with one lender, they have their buckets and that's it.
Let's talk about
the cost
competing. Oh no, one follow-up to that. Can the cost of a 2-1 buy down be less than the savings on the 2% and 1% on the payment?
Typically not. Buy downs usually blow because when you're putting extra money down, you're spreading that over 30 years.
Right. Yeah. For the
And where you're
permanent.
doing
For a permanent.
for a perm, So take that into consideration, right? It's still spread over 30 years. So typically, no, I would say it's not. Usually a 2-1 buy down is still going to blow out the water on any money that you would put down. But again, it depends on how long you keep it, if it achieves its goal. I'm going to tell you, Mike, usually 2-1 and 3-1 buy downs are never worth it. They're never worth it because at the end of the day, the only reason they're worth it is because the seller will pay for them sometimes. That's it. Because at the end of the day, it's something that will go up and you don't make your money back. You can't. The reaping the benefits of buying down the rate is keeping a mortgage for 15 years and saving $100,000 in interest.
Right.
That's really what buying down the rate's for.
It is more a marketing tool or hook than anything, which is okay.
Yeah, absolutely. You can offer people
it's about having a conversation,
right?
Yeah, it's about having a conversation to the point where you can decide or help the client decide what's best for them. But if it gets you the conversation,
I want you guys to understand it. You don't necessarily have to sell it. We will put it together and make it make sense for them. That's our job. But at the end of the day, the more you know, the better, to where you can educate, your buyers to where you feel they feel like you're more an authority figure. They'll stick with you. That's really what we wanted out of this.
Jordan, let's get to your point, and then we're going to come in for a
we
landing
haven't
here.
Talked we haven't talked about this at all. I've priced these all out, me making the max amount of money I can make on a loan. Okay. I can compete for business. I say it all the time. If someone brings me a loan estimate, I will compete for their business. So there's a different way we can price out loans to give better compensation, better pricing. It can kind of separate our compensation out for brokers, which is unique to lenders. It's a way for us to even be more competitive on rates. So we're going to use this as a scenario. Rates just got a whole lot cheaper moving to this. We'll use equity prime because we use them often. Everything's green now, right? On this. Okay. I can get someone, if I wanted to, these credits do not have my compensation built into it. Typically brokers' compensations are at 2.75. Okay. If you look at 6.125, it's roughly right there. That's where we were looking at par rates before. This would separate it out to where we can charge what we'd have to show it on the loan estimate, but we could charge it. So if I only wanted to charge a client 1.595%, I could give a client a par rate at 5.75. Typically, we need a loan estimate to get approval for our company to do that. But there is not a situation where I'm typically going to lose, okay, on rate. And that's really what I wanted to go over. Is if a client comes to me and that says, hey, I'm getting a 6.125, I know I can beat it. I 100% know I could beat it. There's no doubt in my mind. I could beat it all the way down to where if a client wants to do a 1% buy down and also pay my pay my fee or whatever it is, and let's say I'm charging 2%, that would be a total of 3. They would get lower. We'd have to find a different lender, but they would get lower than 5.25, because this would not even be 3 points. This would be like 2.5.
Yeah.
Charging them full. So, but that would be lower. I mean, we could realistically, pretty much beat everybody on rate. Here's a 5, right? If they did a buy down of 1.5 and another 2, that'd be 3.5 points. They could pay a lot of money to do it. Or we can give them a par rate or at like I don't know, 1.9. Again, it's all roughly going to be the same lender to lender.
Yeah.
But really what I wanted to show is that, hey, when you're shopping, is we can cut easier than most retail banks, and you can shop more lenders. So when you're talking about you're talking about being competitive with other banks and LEs, as long as we get the closing cost worksheet and make sure that they're not throwing a fee on somewhere, then we can cut and make sure that we beat them.
Yeah.
Mike says, does the company pay for the discount or does the mortgage agent? The company never pays for it. Like NEXA themselves or Axon themselves, NEXA. If I was going to cut the company's compensation, it would come out of my personal commissions.
Yeah.
I hope that answers your question. It would just be like if a realtor cut their fee. I'm assuming, Josh, to correct me if I'm wrong, if you cut your fee to 2%, it doesn't come out of corporate's pocket, it comes out of your guys' pocket.
Well, it's the gross commission, right? So
It's gross.
they're
So it's a
it's
split.
whatever the split yeah, generally yeah.
Ours is similar. It's similar.
Yeah.
Yeah, it's similar. But I don't want to do that, gets it super complicated. I'm not going to dive too much into that, but just know that when we're shopping with clients or we're doing it, or to make a deal work at times, my lender tells me, sorry, that distracting. I just wanted to show that, hey, it is doable to where we can fight for that business or fight for them to get where they're trying to go.
Yeah.
My lender tells me to not, here, I'm going to stop sharing because it's pretty much done with the rates there.
Yeah.
My lender tells me not to join a company where the underwriter is accessible in-house. If you have no control relationship with them, you're at the mercy. Can you explain how your underwriting is set up? So this is where lenders in-house will, okay. How do I want to pose this to where I'm not totally a jerk? Whatever lender that's telling you that is really full of it. At the end of the day, all underwriters are accessible. I could pick up the phone right now.
Yeah, I mean, we live in a world of accessibility.
It's not I don't know anybody in 11 years of mortgages. I've done mortgages. I have never sat next to an underwriter. Let me put it that way. I've never sat next to their desk. They've never been, when they say in-house, they mean their company employs them, not that they're actually sitting in their office. And you deal with the same turn times at the end of the day. There's still a phone between you and there's still an email between you. But a lot of lenders will use this tactic of saying, hey, don't use a broker or don't use certain lenders that don't have in-house underwriting because they can't have these people accessible. I could pick up the phone and call an underwriter today, call an underwriter right now, and they'd probably answer my phone call, on a file of mine. So I have experience, and this is my personal experience from being lender to lender, is in-house lenders, they when you have in-house underwriting, that underwriting costs money, which ultimately trickles down to your client. Okay.
Yeah.
Where when you have wholesale lenders, their underwriting is with each lender specifically. And that's what I love about deciding is I have lenders that might cost a little more, but they're very fast. Their underwriting is an hour. UWM, I close loans. Our average turn time, we do about $2.3 billion with them a year. Our average turn time with UWM in closings with appraisals is 9 days. That's our average, clear to close. Closing time, 14. You can't do that without, with slow underwriting or underwriters you can't get a hold of.
Yeah. To me, that's antiquated thinking. Um, the other point I'll make with this is this relates to this question and the competing. Jordan, our team, is also great at taking folks that got denied elsewhere and finding a product or program where we can get the deal done. So we'd love the first crack, and we'd love the good ones that the easy loans, but we're really good at the tough stuff too. So I've got some info on the screen here for those who are interested. The QR code at top right is if you or you have a client would like to create an account and start an application. It's very simple and easy. You can scan that or just go to joshesapp.com and you can create a free account and get started with an application. Jordan's contact information is on the screen. My contact information is on the screen. The last thing, and I intended to mention this at the beginning, but I'll mention it here now. We have a program, a dual licensing program, where if you're interested in being licensed both on the mortgage side and the real estate side, you can get paid referral fees and generate mortgage revenue without actually having to do the grunt work of the origination. And you do have to be licensed. There is 20 hours of education. You have to pass a test, but it could be a great way to drastically increase your revenue without having to sell more houses. And for those of you who have been in the business for a long time, or have a lot of past clients, or know a lot of people that own a home, one huge opportunity that is coming is there will be another refi boom, and you can participate in that boom. Whereas if you're only selling and helping people buy, you don't get to play in that, participate in that revenue. And not just the revenue, but it's actually helpful to the clients as well. If you'd like more information about that and how that works and what some of the income opportunity is with that, the QR code at the bottom left is a short 6, 7, 8-minute video overview of that. It's for illustration purposes only, but at least give you an idea of what that looks like. For those of you who are wondering, this will be available immediately on demand after we're done. We will also add it to our YouTube channel, Wake Up Real Estate on YouTube. Also to our website, wakeup.realestate. You can watch this over and over as many times as you would like. Certainly, if you have questions or you have other scenarios, whether it's related to the topic at hand here and pricing out FHA versus conventional or anything else in between. This morning, Jordan and I were working on a couple of DSCR scenarios. We were working on an FHA refi, an FHA purchase, right? So whatever the scenario, we'd be happy to help and do our best in any way possible. To have both license real estate NMLS, do you need to be a real estate broker or does an agent license work? Mike, you're in California. California is weird, but I think
there's California has a special division for dual license people. But we can help you navigate through that. That's not it. You have to have a specific license, a DR. I think it's a DRE. I think it's
DRE, I believe is right.
But you can transfer it. We've gotten them transfer. It's not too bad.
I'm dual licensed. My real estate license is Pennsylvania. I am not a broker. I'm not a real estate broker. I'm a real estate agent, and I have my dual license on the mortgage side as well. So there are certain states. California is really the one that's the most unique, I believe.
Yeah. Well, for the real estate license side, yeah.
Right. So if you'd like to explore that, we'd be happy to just reach out, Mike or other. Again, top right QR code. I'll share my screen one last time.
Guy had a quick thing. I just
good. Yeah, go ahead.
Real quick. Just so he doesn't feel like we ignored him.
Oh, yeah, absolutely. I didn't see it.
Basically, I think what you're asking is like, hey, they work for a different company, so you feel more, it's plausible to think that we're more removed. I would, instead of doing that, I would challenge you. I would say, get your other lender on the phone, say, get me on the phone with the underwriter, and I'll do the same thing, and we'll see who get there first. So I would guarantee that that would happen. I would sell exactly what he's telling you is exactly what I would tell people when I was a retail lender. I would say that brokers are more removed. I would say whatever I needed to. I didn't understand because I never worked on the broker side, but that's what my mentor told me at the time that's how it was. That's really not the case. It depends. Each company depends. I'll give you an example. My processor works for a separate company, but she's also my wife and she does get things done very quickly. So it just depends on where you're at, but she does not work in the same office as me. I work in a completely different office as her, right? So there's still an email, there's still communication there,
And
so
also, not all retail lenders are created equal, and not all mortgage brokers are
yeah.
created equal. You have to know that you are working with someone that is motivated, that is diligent,
And
and that knows what they're doing. And the reality is, and this is on real estate side and on the mortgage side, there are lots of folks that aren't or don't. Okay, so you
yeah.
want to align yourself, whether it's with us or someone else, but align yourself with people whose goals are aligned and that you vet very carefully and are confident are in the boat with you, right? Like, are you're both rowing in the same direction.
And
Uh,
well, I want to do it is it's proper expectations, right?
yeah.
So it too, people setting the proper expectation. We just did it today. If someone needed funding before the end of the year, and we said no, can't do it. I could have been a
Well,
yes man and said
we said
yes.
this option
Possible.
we can't do it. We said this option we can't. Option one we can't. Option two maybe, but
Yeah.
just being honest,
Yeah.
right? Like not stringing people along saves a lot of headache and heartache in the long run.
Yeah.
Um,
I would say just try them out. Try them out. But at the end of the day, I've worked with retail lenders where we couldn't even speak to underwriters or processors, right? There are retail lenders out there. It just depends on how they're set up internally, right?
yep,
But I know how brokers, and same with our brokers. There's lenders that we go to on a broker side that don't allow us to talk to underwriters. And then there's with UWM where there's 3 of them on a file that we can get a hold of all 3 of them within an hour.
yep.
So it just
So
depends.
Kristen, you're very welcome. Thank you for that. I've got to wrap up because I have a Zoom starting here in a minute. But once again, well, the recording, the replay of this will be available immediately afterward. We'll get it up at Wake Up Real Estate YouTube channel. We'll get it on wakeup.realestate. If you have questions, scenarios, you need help of any kind, our contact information is on the screen right now. And if not, it should be in the description wherever you're watching or listening to this. We appreciate you spending time here with us. Jordan, thank you for the expertise and the knowledge. And stay tuned. We'll have more great mortgage related topics coming very, very soon.
Thanks, Josh.